Avoiding overfitting in trading, strategies for adapting to live markets. Investing in financial markets is no easy task, and with the rise of data-driven and algorithmic trading, new challenges emerge. Among them, overfitting stands out as a pitfall that affects many traders, even experienced ones. This video is designed to help you as an investor identify, understand, and overcome overfitting to succeed in live markets. By learning strategies to build resilient systems and adapt to changing market conditions, you'll reduce costly mistakes and boost the reliability of your trading decisions. Let's dive into the world of overfitting, how it affects trading strategies, and the steps you can take to avoid it. Overfitting refers to the phenomenon where a trading model becomes too closely tailored to historical data. While it might appear to perform flawlessly during backtesting, its performance in live markets often deteriorates. Why? Because the model isn't learning the underlying market processes, it's memorizing the quirks, anomalies, or even the noise in past data that no longer hold true in real-world scenarios. When a model is overfitted, it's like preparing for an exam by memorizing the exact questions from past tests instead of mastering the subject matter. The result? Failure when confronted with new challenges. This same concept applies to trading strategies. Overfitting doesn't just harm your financial performance, it undermines your ability to make data-driven decisions. That's why recognizing and addressing it is essential before implementing any complex system. Backtesting, although an incredible tool, can often give traders a false sense of confidence. A model that performs well on historical data might mislead traders into thinking it will perform similarly in the future. Live markets are dynamic and constantly changing, driven by factors that aren't always present in historical data sets. Overfitting can result in false positives, strategies that trigger unnecessary trades; unclear signals, confusion due to reliance on irrelevant patterns; financial losses, allocating resources based on models that fail to adapt to present conditions. As investors, your goal should always be to create strategies that generalize well over time and across varying market environments. Let's explore how you can design these resilient, adaptable trading systems. One of the most critical steps in avoiding overfitting is knowing how to spot it early. Some common signs include exceptional backtesting results. If a model shows unrealistically high success rates in backtesting, chances are it's overfitted. No system can achieve consistent perfection. Poor live performance. Strategies that fail to maintain their profitability during live trading often indicate overfitting during their creation. Overly complex systems. Models with too many parameters or intricate rules may have simply memorized historical data rather than identifying broader market behaviors. Recognizing these patterns will set the stage for designing models that are robust, reliable, and effective in real-world application. The first step to avoiding overfitting is creating models that focus on capturing the essence of the market, rather than its granular details. Here's how you can make your trading systems more generalizable. Simplify algorithms. The simpler the model, the more likely it is to capture the core market dynamics without relying on irrelevant patterns. Think of simplicity as a safeguard against overfitting. Focus on long-term trends. Models that emphasize broader market movements and trends fare better in unpredictable live conditions. Short-term anomalies in past data can often be misleading. Select relevant features. Resist the temptation to include every possible input in your model. Instead, focus on data points that truly drive market changes, such as macroeconomic indicators. For example, a simple moving average strategy focusing on longer time frames might outperform a complicated algorithm with dozens of rules. Testing is where traders often go astray. Relying solely on a single backtesting method risks trapping your strategy in the overfitting cycle. To break free, implement these techniques. Cross-validation. Divide historical data into multiple subsets to test the model in diverse scenarios. By training the model on one subset and testing it on another, you'll assess its ability to generalize. Walk-forward testing. Analyze your model's performance by splitting data into sequential timeframes. This mimics real-world conditions and enables you to assess how well the model adapts over time. Out-of-sample testing. Evaluate your strategy using data it hasn't seen during development. This ensures the model isn't overly optimized for historical data, but remains versatile for unseen conditions. Through rigorous testing, you'll build confidence in your model's resilience and reduce the risk of overfitting. Developing a robust trading model isn't just about avoiding overfitting. It's also about recognizing that no strategy is perfect. Risk management plays a crucial role in protecting your investments when the unexpected happens. Dynamic position sizing. Rather than committing to fixed positions, adjust your position size based on market conditions or the confidence level in your model. Mitigate over-reliance on one model. Diversify your portfolio by employing a mix of trading strategies to balance risk. Avoid emotional decision-making. A solid risk management system helps prevent knee-jerk reactions to short-term losses, ensuring you stick to your strategy's long-term goals. Managing risk effectively is like having a safety net. It ensures you survive market turbulence, even if things go awry temporarily. Markets evolve, and your trading strategy should too. A significant reason overfitted models fail is that they're static in a dynamic environment. To stay ahead, commit to continuous improvement and recalibration. Monitor your strategies. Constantly review how your models perform under changing conditions. Regular audits help you identify whether recalibration is necessary. Incorporate real-time insights. Use current market data to refine your models instead of relying solely on historical data, which may no longer be relevant. Update periodically. As new data becomes available, integrate it into your testing and development processes. This keeps your strategies relevant and geared toward future performance. Iterative updates not only improve accuracy, but also ensure your models don't fall prey to outdated assumptions. Modern trading offers access to powerful tools that can help you steer clear of overfitting. Machine learning in particular has emerged as an excellent tool for building adaptive trading systems. Dynamic learning models. Unlike traditional models, machine learning algorithms can dynamically adjust as new data flows in, helping you adapt to live conditions. Live monitoring and feedback. AI-powered tools enable you to monitor your strategies in real time and receive actionable insights to adjust as needed. Human oversight. No tool is infallible. Always pair automated systems with your expertise to catch potential errors that algorithms might miss. Balancing technology with human judgment is the key to creating a system that is both precise and adaptable. Even the best trading systems rely on the mindset of the trader using them. To navigate today's dynamic markets, cultivating the right approach is equally important. Embrace flexibility. Understand that markets are unpredictable, and clinging to rigid strategies or assumptions doesn't align with reality. Commit to lifelong learning. Always be open to new tools, techniques, and insights. The faster markets evolve, the more you'll need to adapt. Focus on consistency over perfection. A consistent, realistic strategy is far more valuable than chasing perfect backtesting results that fail in live scenarios. By embracing growth and adaptability, you'll build the mental resilience needed to succeed in the ever-changing world of trading. To wrap up, here's a checklist to help you avoid overfitting and enhance your trading success. Simplify your models to focus on general patterns, not historical quirks. Test your strategy thoroughly using cross-validation, walk-forward testing, and out-of-sample evaluations. Periodically recalibrate and refine your models based on current market data. Use advanced tools like machine learning for dynamic adaptability. Stay flexible, manage risk, and prioritize consistent performance over perfection. By applying these principles, you'll not only sidestep the pitfalls of overfitting, but also develop a trading system built to thrive in live market conditions. Avoiding overfitting is a critical skill for today's investors. By combining technical expertise with a proactive mindset, you'll stay ahead in the world of dynamic trading. Remember, success isn't about predicting the future, it's about preparing for it. If you found today's video helpful, please like, subscribe, and share it with someone who could benefit from these tips.